Markets are in a turmoil as the world's two largest economies are moving further away from returning to the table to de-escalate the trade war, and as U.S. manufacturing shrunk for the first time in 3 years. The drop in the ISM Purchasing Managers Index to 49.1 in August is the first concrete sign that the trade war is hurting U.S. manufacturers, and that only seems to have hardened U.S. President Donald Trump's stance against China, as he tweeted that a deal after he gets re-elected, and that's a big assumption, would be harsher. This doesn't bode well for the S&P ASX 200 index: AXO, ASX, XJO index, with the futures market pointing to a 0.6% drop at the open. Growth stocks exposed to U.S. economy are likely to take the brunt of the negative sentiment. These include the Brambles Limited, ASX, BXB, share price, and Afterpay Touch Group Limited, ASX, APT, share price, just to name a few. Is it time to be a contrarian investor? But this could be the best time to bet on a trade deal outcome, according to Bank of America strategist David Wu, who was interviewed on Bloomberg. Talk about a contrarian trade. Wu said he is reasonably optimistic as he thinks the pressure is on for Trump to strike a deal in the near term to avoid sending the U.S. into an economic downturn ahead of the November 2020 election. Time is running out for the incumbent president if you believe the bond market. The inverted yield curve, which have reliably signaled a recession in the U.S., indicates that its economy is likely to go into reverse around election time. There has only been one time in the past 50 years that a recession had coincided with the presidential election, according to Wu. This shows how far U.S. commander-in-chiefs will go to avoid one. In case you are wondering, the lone unfortunate president that had to face voters amid a recession was Jimmy Carter, and he lost. The Aussie could be a top performer. We probably wouldn't need the US and China to kiss and make up either to trigger a surge in risk assets, such as shares. Any signs that they are working together to ease trade tensions will be enough, given that global markets haven't priced in any of this potential positive outcome. But it isn't only equities that are set to bounce sharply. Wu believes the Australian dollar is likely to be one of the best performing assets on the back of easing tensions, as the Aussie battler has been hammered over the past several months due to our reliance on the Chinese economy. Conversely, the rally in bonds that have depressed yields, price and yield move in opposite directions, would be over. This could mean borrowers won't be able to enjoy record low interest rates for that much longer. That's not a bad trade-off for the return of economic growth. Our top 3 blue chip shares for 2019, now available. You're invited. For a limited time, the Motley Fool Australia is giving away an urgent new investment report detailing our 3 top blue chip shares to own in 2019. So if you like trustworthy, stable, high-performing companies that pay fat, fully franked dividends, we've got you covered. Stock number 1 is a beloved old Australian company turning its attention to high-margin businesses and rapidly returning cash to shareholders with its hefty dividend. While stock number 2 is an online powerhouse that's rapidly gaining market share all around the globe. Poised for years, or even decades, of tremendous growth. Even better, stock number 3 offers a whopping 6.5% grossed-up dividend, which beats the rates on term deposits right out of the water, and offers the potential for capital gains, too. You can discover all 3 shares inside our new report right now. To scoop up your free copy, simply click the link below right now. But you will want to hurry. This free report is available for a limited time only. Simply click here for your free report. Motley Fool contributor Brendan Lau has no position in any of the stocks mentioned. Connect with him on Twitter at @BrenLau. The Motley Fool Australia owns shares of Afterpay TFPO. We fools may not all hold the same opinions, but we all believe that considering a diverse range of insights makes us better investors. The Motley Fool has a disclosure policy. This article contains general investment advice only, under AFSL 400,691. Authorized by Scott Phillips. Let's block ads. Why?